Welcome back to the Williams Real Estate channel. I'm your host, Geordie Williams. Today we are discussing my latest purchase I personally made in August 2024, middle of last year. As you can see on the screen, it is a block of units, 4 times 1 bedroom units. It is on a parcel of land of 900 squares. It consists of a double brick, low set structure with ColourBond roof and ColourBond carports, and consists of the driveway is like that country road, just a seal coat, asphalt, concrete walkways. So very low maintenance complex. All I've done to date has been clean up the eaves, paint the eaves and the gutters. They were looking a little bit tired when I first purchased it. And that's it. It was already fully tenanted to 4 individual tenants. It is also strata titled, meaning I could sell these individually. And as you can see, it is a very neat and tidy complex. Classic. I love this type of stuff. This is personally my goal is to only buy this type of stock for myself moving forward. From where I'm at, I've got 2 townhouses up in Brizzy, about 10 houses. I've got a duplex and this block of units. So I'm looking to continue to keep buying this stock by way of selling down a single family house to then pay down the debt, raise cash, to then roll the capital gain as a deposit into more blocks of units just like this across the country. They are a great play once you've built the portfolio to, say, that 10 residential foundation portfolio. If you're looking to grow and continue to scale, then the best way to then scale up is to start buying blocks of units. So for every one house or singular property I own, I could trade that into a block of units by recycling the capital into my family trust that I have to then leverage against that capital to buy blocks of units, that cash flow, and then get the loans out of my personal name and continue to keep growing and building the portfolio within the trust to continue to keep scaling and moving forward. But this one here is a very neat and tidy example of what I can help you if you've already got a couple of properties and you're looking to move to that next level. This is a great play because this type of property has a solid, strong cash flow, and we'll run through the numbers in a sec, but also has the good capital growth opportunity by way of refinancing them once you can convince the bank they're worth more based off the being strata titled, or even selling them individually down the track. They also have a large land component, so they'll get good solid growth. And being already a multi-residence site, it has the zoning. So at some point, maybe even worth knocking it down and redeveloping the site to put, say, 10 or 20 units on it. The sky is the limits when you are buying into blocks of units. Ultimately, blocks of units is where you want to land. I like to start people off in singular units to get into the market, easy to get in with not much capital, then you move on to a couple of houses. Once you're into a couple of houses, then you want to look at this type of stock. And then if you want to keep going, you can then look at, say, boarding houses and then go into easy way into commercial property once you've got that solid residential foundation backing. This type of stock, you will always find a tenant. There's always demand and there's never enough supply of affordable housing. This is what it really is. It is affordable accommodation. And this is the numbers now. I can show you. So I purchased this property for $665,000 back in August last year. Ownership structure has been purchased within my family trust that I have set up for my family. So I'm the trustee, and my wife and kids and a companies are beneficiaries of that trust. So I can control the trust, and then the proceeds or the funds that can be distributed or need to be distributed every year out of the family trust can either go to my wife, children, or a company structure to minimize tax. So I don't receive the money. It can go to the rest of my family, and you can still control the money without having to pay 45, I think it's even more these days, 47% tax to good old Anthony Albanese. So that's a good way to structure your properties once you start to hit your serviceability limits and your land tax thresholds in your personal name, is to start looking at setting up a family trust. Won't only allow you to minimize your tax, but it'll also allow you to increase your serviceability. As when you buy property in your personal name, the banks typically put a 2 to 3% interest buffer on the interest rate. So most people are getting assessed at around that 9-10% interest these days. And they also shave the rental income. They typically only take up 70 to 80% of what the rental income is. That's when it's in your personal name. When you buy in a family trust, they take it on face value. So you automatically have increased serviceability in a trust as they're taking a full rent and they're only factoring in the cost of the actual interest rate that you're paying. And that means your serviceability will grow. Obviously, keeping in mind, you will start paying land tax on day one. You can't offset any negative gearing in a trust. And so it does have a higher administration holding costs owning a property in a trust. It'll also cost you a little bit more every financial year with your accountant to submit it through to the ATO and do the back end accounting works of it. It's like running a business, like running a small business. So it is another added layer of complexity. However, it'll open up more doors for you to continue to keep growing and building your portfolio. I suggest, this is by no means financial advice. You got to talk to your accountant, financial planner, lawyer, solicitor, whoever. But this is what I did. This is what I do. I believe it's good just to start out in your personal name because you get the benefit of your land tax thresholds in each state. It's relatively easy just to buy in your personal name. And then once you are hitting your limits, both serviceability and also your land tax thresholds, because once you start hitting those limits of the land tax thresholds, you'll start paying land tax anyway, then it will make sense to start buying into a family trust to keep growing your wealth, get more serviceability, but also added layer of protection. If you have a business and if you're a doctor and a dentist or a business that has a high risk of being sued, then it's also wise to structure your assets in a trust. So then it's another layer of protection if there is ever a creditor trying to claim against your assets, you don't technically own any property. The trust owns it. Obviously, it's not going to stop anyone from suing you. Anyone can sue anyone if they've got a claim or a reason to sue someone. It won't stop them, but it just makes it a lot harder to continue to keep proceeding to get capital out of someone if it's held in a trust structure versus if it's in a personal name. These are things you need to run through with your lawyer, solicitor, accountant. If you don't have any of those people, shoot me an email. I'll put my details in the comments below. I can connect you with everyone you need to build your portfolio. But back to it. So I bought it for 665 grand market value. If I sold them individually, easy 220, if not a little bit more. So that makes it 880,000 market value. And really, you'll find it's pretty hard to get deals like this. I managed to negotiate this one pretty well off the wife of the owner. The owner was selling up all his estate as he was looking to retire, and I managed to negotiate a pretty good deal on it. As you can see, it could easily sell now for 800-900 current market. So good uplift within not even 12 months. I haven't yet refinanced this one, so I still only have the original loan. Keeping in mind when you're going into these types of properties, you typically need a larger deposit. So 70%, 7% loan, 69% loan. So typically 30% minimum. If not, some banks need 40 or even 50 if you're going a larger block of units, say like a block of 6 or 8. But 4 units, up to 4 is still considered residential. So typically 30%, 20 maybe, but typically 30% deposit. As you can see, I am paying a good old interest rate to Liberty, 7.99%. As I have maxed out my serviceability currently with the big 4 banks or CBA, I've got about 40-50% with CBA still, and about 50-55% with the smaller lenders. My strategy is I like buying through the smaller lenders, and then after a little while, you can refinance back to the big 4 and get a better rate. Because once you sort of hitting your capacity with the big 4 banks, the smaller lenders will continue to keep lending you more money at a higher rate. Obviously, I'm paying 8%. But after 2 or 3 years, you can go and chat with your branch manager or your mortgage broker, and you'll find that once you build the equity up in the deal, the big 4 banks want to do business, and they will potentially offer you a better rate to refinance back, so you can consolidate over time back to the larger banks. So I typically acquire through the smaller lenders. They'll give you the money, hard money lending to get the asset, hold it, stabilize it, push rents, renovate it, push the yield, and then go back to, say, CBA and say, hey, do you want to do business or not? Otherwise, I'll take it all to Westpac, and play the banks off, play the mortgage brokers off. You need to move and shake. If someone says no, find someone who says yes, that they can help you. So I'm always pushing the limits, but that's what I typically do these days. So I'm yet to refinance this one. It is on the to-do list, but as you can see, there's 400 odd thousand worth of equity. If I liquidate it today, I could make 300 odd thousand. I've added in all these calculations of how to do that. So if you want this spreadsheet template, shoot me an email. I can send you it. You can plug in all your properties as you continue to keep growing. I've added them row by row. I've just filtered it just for this one today. But accessible equity, 245,000, and that's not even within 12 months. So debt to equity ratio, this is what the big four banks want to see. They want to see it at least less than 50. Once it's less than 50, so once you push the rents, the rents will then get capitalized on the high price. If you strata title, once you push the value, then the big four banks will come to the table again and look to refinance at a better rate. So currently it's bringing in a gross rental yield of 11.7%, a net yield of 0.8%. A lot of it is going to Liberty at the moment, but once you get a better rate, that'll improve the net return. Insurance, this is just a prompt to remind me of when insurance is due. Leases, this is the breakdown of every unit of what they're renting for. So they're ranging between 250 to 280. I'm in the process of pushing them all to market. Should be around that 280, $300 a week. Obviously, once they've locked in, or 260 to 280 mark per week each unit. But if they're locked in a lease, obviously you can't push it. So I track here when the leases are due to expire. So then it prompts me to then push the property managers to push the rents when it's due to time to do so. Also, last inspections, I like to just track this just to keep on top of making sure that the property managers are going and checking them out every at least 3 to 6 months. Provided it's getting checked every six months or so. I just don't like seeing them when they're lingering around from a year or two ago. That's always a bit of a red flag. We want to make sure that we keep monitoring the tenants just so there's never anything bad happening within your property. So good to keep an eye on them and good to keep an eye on the property managers to make sure that they are staying up to date with it all. So the numbers, it's currently bringing in 4,400 or nearly 4,500 a month. Interest to 2,800. Mortgage, including principal and interest, is 3.5 a month. Agent fees, 295. Insurance, 182 a month. Council rates, 726 a month on average. Strata or Owners Corp, 0, because that's me. I own it. I have to maintain, upkeep it. And I put typically 3%, but I put 4% for this one. It's a larger asset. So 4% of the rent as on average, how much to maintain and upkeep it. But actually this one's pretty well neat and tidy. Doesn't actually cost me too much, this one. So yeah, 3-4% of the rent you can expect for maintenance. You can probably go 4-5% if you're getting a, say, a weatherboard property, 2-3% if it's a brick low maintenance complex or low maintenance property. So that's just not that goes out every month, but just a bit of a guide of what to expect. So total costs currently 4,900 a month. So P&I, it's currently negative on principal and interest, but principal is not a cost, that's paying down debt. And the net is $330 a month on average. So sometimes more, sometimes less, depending if there's rates due or maintenance upkeep or insurance payments due or what have you, or if there's a tenant that's moved out, or if there's fully let, give or take. But on average, currently with the high interest rates, it is netting $330 a month. So pretty good return for straight away. It's positive geared. These are just other notes I've put in here. Depreciation. So I can actually need to get a depreciation report done for it, not for the external. There wouldn't be anything left to claim on this. I believe it was built around the 70s, I think 75. But internally, it has been renovated recently. So there would still be money left on the kitchens to claim. They all look like this. They're all identical. So I would say probably around 20 or 30 grand per unit, I could get a depreciation report done. So then that will then factor into reducing how much tax I have to pay come the end of financial year, which is usually around, uh, I'd say a couple of grand a year for this type of asset that you could deduct. What else have I got? I've got general maintenance requirements. A fence on one side of the property is an old timber fence that at some point will need replacing. I'm just tangling with the neighbour. She wants to remove an old timber fence to replace it with another timber fence. And I've said, look, if we're going to replace the fence, I'm going to do it in colour bond. I'm not going to replace a timber fence with another timber fence that will have the same issues of missing palings. So I've touched up the fence, fixed the palings in the meantime, but she still doesn't want to come to the table to pay for the extra over for colour bond. These are the things this is property management, the fun and games. So there's an email there from a property manager that they've got a quote for replacing it in timber, and it's about another 2 or 3 grand for doing it in colour bond. So anyway, see how that plays out. The fun and games you got to play. Owned by the tenant, I also have just a space here in the spreadsheet to put in stuff that's ever owned by the tenant. Example, if they break something, need to fix it, or water, whatever, then that's just a prompt to remind myself to push the property managers, because you got to drive the property managers. They'll manage it, but ultimately you should drive your property managers to get the best out of your properties, because if you just let it go by the wayside, people become a bit sloppy. But that's it. If something like this is of interest to yourself, a neat and tidy little block of units, happy to help. Very good to complement a portfolio once you've got, say, 3 to 5 residential properties and you're looking to add to your portfolio. I suggest getting into a couple of these before heading into commercial, because check out another video. I'll put the link in the comments below of my thoughts of commercial and getting into early. Personally, I'm not in commercial yet, and I'm going to roll all my singular properties into stuff like this before I then look to go into commercial. And when I do go to commercial, it'll be looking like a boarding house first. So 20-room boarding house, rock solid, stable, resilient commercial. So blocks of units, boarding houses, before you then start looking at the likes of retail and office space and factories and warehouses, because that stuff can go vacant for many, many years. So if you want help buying something like this, shoot me an email, send me some feedback. Until next time, thank you very much for watching.